Rohr here with an early global view on Tuesday, August 19th, 2014. It's currently 7 a.m. U.S. Central Time, and even though this is a global view, it'll be relatively concise because quite a bit is playing off levels we have discussed previous in the various asset classes, except maybe for the strength of the fixed income. And as far as the uh, macro factors go, it's important to remember that this week sees a lot of central bank influence once again on Wednesday with the Bank of England minutes and the Fed minutes, and then on Friday as both Janet Yellen and Mario Draghi speak from the Fed get together in Jackson Hole, Wyoming. Kind of important to consider how all of that is playing with the markets. And the most interesting aspect is that with all that bad news last week, the equities, not just the S&P, but the European equities as well, even the previously smashed DAX, managed to have a nice recovery. And as we had noted previous, the 1950 to 55 area was an important area in the S&P future, and it managed to push back above it on Friday, then was hit with the concerns over renewed confrontation in the Ukrainian-Russian imbroglio, and sharply sold off, but came back to close right back in that range. So the gap higher yesterday on Monday was pretty constructive, so it is now back above the 1934 to 38 area. Interesting, in fact, where it held that sharp sell-off on Friday. And it is back above 1950 to 55, and therefore, even though it looked like it stalled a bit yesterday, you have to note that the hourly MACD is still out above its upper runaway band, and that the higher resistances don't come in till about 1975 to 78 area. That's based on the hefty old congestion either side of that ultimate top at 1985.5 several weeks ago. In fact, our view is if this thing gets much through 78, probably won't stop at 85. And the next oscillator and topping line resistance on the intermediate term chart is not until up around the 2005 area. And of course, the previously mentioned resistances remain the key lower supports. And moving over to the intermediate term, we can see all of that in the flesh on those intermediate term indications. And that would be the topping line, which is also consistent with oscillator resistance at 135 over a 1,870 41-week moving average. So those are very much back in sync. We can also see that by overrunning 1950, the market overran the 13-week moving average as well, and you can see all the previous congestion right around 1955 to 50 going back into June and July. Of course, that was the very level that the market broke below to create such weakness going back to several weeks ago on Thursday morning, when it finally gapped below that on the geopolitical concerns and did hold the lower ground into the important gap support, which was at 1904 on the weekly chart, the gap up in late May, coming back in from Memorial Day weekend. And as we noted on the September chart, that was against the pre-gap high right around 1890. And in fact, going back to 2 weeks ago on Friday morning, the market did hold right into 1890 an overnight trade before U.S. action in Iraq restored some confidence and set it back on the rising path. So this is why we're looking so closely once again at 1950 to 55. And for any of you who missed it, we also had a commentary out last Friday on why we're still skeptical of the equities in the intermediate term, more of a fundamental view on U.S. wages and housing. And we encourage you to look at that for the broader macro background. But in the meantime, that pretty much does it for the S&P 500.